There is a conversation about AI income that almost never happens in the content you are watching. Everyone talks about what you can make. Very few people talk about what you keep. And the difference between those two numbers is more significant than most people building side income realize. This video is about the practical financial reality of earning side income as an adult. The taxes, the structure, the tracking, and how to account for it so your income projections stay accurate. I want to be clear upfront. I am not a tax professional or financial advisor. What I am sharing here is general educational information. For your specific situation, you should consult a qualified tax professional. But the general principles are worth understanding before you build your income numbers around assumptions that may not reflect reality. When someone on YouTube says they make $2,000 per month from AI income, they are almost always talking about gross revenue, the money that came in before anything went out. Now let us look at what went out actually means for a self-employed side income earner. There are three main taxes that apply to self-employment income. The first is federal income tax. Side income is added on top of your existing income, which means it is taxed at your marginal rate, your highest tax bracket. For someone earning $60,000 to $90,000 from their primary job, additional income is typically taxed at 22 to 24%. The second is self-employment tax. This one surprises most people. When you earn self-employment income from a service, a product, or freelance work, you owe self-employment tax on top of income tax. This covers Social Security and Medicare. The current rate is 15.3% on net self-employment income. You owe this whether or not you have a separate business structure. The third is state income tax. This varies significantly by state. It ranges from 0% in states with no income tax to over 9% in high-tax states. For someone in a moderate tax bracket in a moderate tax state, here is a rough combined effective rate. Federal income tax at marginal rate of approximately 22 to 24%. Self-employment tax of approximately 15%. State income tax of approximately 5%. Combined total of approximately 40 to 44% on self-employment income. Let us run that against the $2,000 per month example. $2,000 in gross income minus approximately 40%. Net income after taxes is approximately $1,200. That is not $2,000 per month. That is $1,200 per month. Still meaningful. Still worth building. But the retirement projections built around $2,000 need to be recalibrated around $1,200. This does not mean AI income is not worth building. It means your planning needs to account for the real number. If you are building toward $800 per month in net AI income, the income goal you actually need to hit is closer to $1,300 to $1,400 gross. Building toward $1,000 gross and expecting $1,000 to show up in your retirement account will leave you short. This is a planning issue, not a reason to avoid building. Now let us talk about what to actually do about this. Step 1 is setting aside taxes from every payment. The most common mistake new side income earners make is treating all incoming revenue as available income. It is not. A reliable approach is to move 30 to 35% into a separate savings account dedicated to taxes as soon as income arrives. Do not spend it. Do not invest it. Just hold it. At tax time, you will either owe roughly that amount or you will have a small surplus. Step 2 is understanding quarterly estimated taxes. If you expect to owe more than $1,000 in taxes on your side income, the IRS typically expects quarterly estimated tax payments. Missing these payments can result in penalties even if you pay in full at tax time. Quarterly deadlines are generally mid-April, mid-June, mid-September, and mid-January. Consult a tax professional to understand your specific obligation. Step 3 is tracking every business expense. Side income comes with legitimate deductions. Software subscriptions used for the business. A portion of your internet bill if used for business. Equipment purchased for the business. Professional development related to the income activity. These deductions reduce your taxable income, which reduces your tax bill. Most people building AI income leave significant deductions on the table simply because they do not track expenses. A simple spreadsheet with date, description, and amount is enough to capture everything at the start. Step 4 is considering a simple business structure. This is where a consultation with a CPA or tax professional becomes genuinely valuable. Depending on your income level and situation, operating as a sole proprietor versus an LLC or S corporation can have meaningful tax implications. These structures are not complicated to establish, but the right structure depends on your specific situation. Get professional guidance on this one. Step 5 is keeping business and personal finances separate. Even at the earliest stage of side income, open a separate checking account for business income and expenses. This makes tracking easier. It makes tax preparation simpler, and it creates a clear record if you are ever audited. Here is what the tax conversation often obscures. Self-employment income, while taxed at a higher combined rate in some ways, also comes with deductions and flexibility that regular employment income does not provide. Business expenses reduce taxable income dollar for dollar. Retirement contributions through a SEPIRA or solo for $101,000 can significantly reduce taxable income while building retirement savings. A solo for 401k, for example, allows contributions that can dramatically increase your tax-advantaged retirement savings. For an adult building income specifically to accelerate retirement, this is worth understanding. The same income that is being taxed at a higher rate can also be used to contribute more to retirement savings than regular employment income typically allows. Which means the combination of AI income and a solo for 401k can accelerate retirement savings in a way that traditional employment income alone cannot match. The practical takeaway from this video is not that taxes make AI income not worth it. It is that AI income, like all income, needs to be planned with real numbers. Set aside taxes from day one. Track expenses from day one. Understand your quarterly obligations. Get professional guidance on structure when income becomes meaningful. And plan your retirement projections around net income, not gross revenue. The income content you watch online almost universally focuses on gross revenue because gross revenue is the impressive number, but you are not building an audience. You are building a retirement plan, and retirement plans built on gross revenue assumptions will disappoint you. Plans built on net income reality will serve you. Know your numbers, all of them. The free AI catch-up calculator in the description is built around net income assumptions, not gross revenue. When you run your numbers, you are seeing the realistic impact on your retirement timeline. And if you want to understand the full financial picture of building structured AI income, the videos on this channel walk through each component. Start with the calculator. Then explore the playlist. Links are in the description. Let us also address the question of what to do with AI income that is being generated and how it fits into the overall retirement picture. There are two primary strategies for deploying AI income in a way that maximizes its impact on the retirement gap. The first strategy is direct contribution to tax-advantaged retirement accounts. If you are earning self-employment income, you have access to retirement account types that offer significantly higher contribution limits than traditional employment accounts. A solo for 401k, for example, allows contributions as both the employee and the employer. As of recent tax years, this can allow total contributions significantly higher than what a standard employer-sponsored for 401k allows. For someone earning $2,000 per month in self-employment income and putting that money to work in a solo for 401k, the tax benefits are substantial. Not only does the contribution reduce your current year taxable income, but the investment grows tax-deferred. For someone with a 10 to 15-year horizon to retirement, the combination of tax reduction now and tax-deferred growth across that period produces a meaningfully different retirement picture than imply depositing the income into a regular savings account. A qualified CPA or financial advisor can help you structure this correctly for your specific situation. The general principle is worth understanding even before you get to that stage. The second strategy is using a portion of AI income to pay down any high-interest debt before retirement. For someone carrying credit card debt or other high-interest obligations into retirement, eliminating those obligations before leaving full-time employment reduces the monthly income requirement in retirement. A lower monthly income requirement means a smaller portfolio withdrawal. A smaller portfolio withdrawal means the retirement portfolio lasts longer. The math works in the same direction as adding more to savings, just through a different mechanism. The specific allocation between additional retirement contributions, debt paydown, and direct savings depends on your individual situation. The important point is that AI income has more leverage than it appears when deployed intentionally rather than simply deposited alongside regular income and spent. $2,000 per month in AI income, deployed strategically into a solo 401k or toward high-interest debt elimination, produces a meaningfully different retirement outcome than the same $2,000 flowing into general spending. Be intentional about where it goes from the beginning.